Catherine, let's start with you. We've been looking at these numbers coming in much better than anticipated, and you think it's enough to continue to support the returns that we've seen in the market to this point?
Well, this quarter and next quarter, Becky, certainly base effects are so favorable that this is going to be an ongoing phenomenon, given last year's first quarter and second quarter really was so devastating. I'll add to that pent-up demand remains. I was looking at household indebtedness over disposable income, and that ratio is at the lowest since the 1990s. So yes, it's already low, but as the economy continues to reopen and people get vaccinated, we should expect additional spending on all things recreational, all things consumer related.
Hey, Valerie, one thing you point out is that growth stocks have really started to pick up once again. You know, we were looking at the value stocks kind of outperform for a little while. But over the last month, we have continued to see some of those growth stocks pick up. And I think for the month of April, if you're looking at the Dow components, Apple and Microsoft are the best performers. Do you think that condition lasts?
I think certainly that condition can last, but what this really points to is the need to maintain a level of diversification in terms of the kind of exposure you have in your portfolio. Certainly, we did see a value rally earlier in the year. That's been a bit more muted more recently, but the growth and the momentum stocks have continued to perform. So I think it's important to maintain exposure to both. You know, if you look at the consumer discretionary sector as an example, there are a lot of stocks there that were beaten up and didn't participate in the reopening trade. And many of those, as we come into this phase of the recovery, will probably perform quite well. So I think there's opportunity in value as well as growth in the current environment.
Hey, Catherine, what are your favorite plays right now?
I think there's opportunity in the green energy space. It's been beaten up pretty badly, Becky, since early February, and a lot of the infrastructure spending bill is devoted to green energy efforts as well as healthcare. So those are two sectors that I think can do very well. I also like consumer staples. Consumer staples tend to outperform in what I think is inevitably going to be an inflationary environment, given the combination of variables, which are both monetary, fiscal, and fundamental in nature. So I would say that's probably the best pick. In terms of the barbell strategy, which is our favored strategy in this current scenario, we like offsetting any risk. Risk, of course, being overweight equities, going long emerging markets, which are additionally quite beaten up. Offsetting that with inflation-protected instruments. I already mentioned consumer staples, which fare well in an inflationary environment, but also tips, even gold, and especially alternatives, which tend to have a low correlation to the broader and more conventional equity and bond markets in private equity and venture capital, even commodities. So I think, as Valerie said, diversification is very important, but I would add to that inflation protection is very important, which is something, and I think even though we have discounted it, we may not have discounted the proximity of that inflationary effect.
Are you really worried about inflation, Catherine? Is that a big issue that you're talking about, or you just think that it could be something that's out there, or is something kind of further down the horizon?
It's further down the horizon, but I think it is inevitable. We've seen velocity of money fall off a cliff, and that's the reason why double, triple-digit moves in M1 and M2, which is the monetary base, has had no effect. So one has to ask herself if the velocity of money is going to continue this extraordinary downward spiral. And my suspicion is that no. So I think that inflation, the timing is infamously difficult to predict, but I would say that it's on the 12 to 18-month horizon, Becky, which is why I think inflation protection should be incorporated into any prudent investor's portfolio right now while it's still relatively cheap, and we can position for that unknowable future point, but be ready for it.
Shepard Smith here. Thanks for watching CNBC on YouTube.